Hey everyone, welcome back. So I hope you guys are having a great weekend. I wanted to go over something. So I've been trying to do a little research as far as what is better to invest in as far as timing goes, right? Is it best to try and get in at the bottom, trying to figure out if it's best to kind of dollar cost average in? Is it better to just dump all your money in at the market at the beginning of the year? What is the best way? So I did a bunch of research online. The best article I found was actually by Charles Schwab. So we'll look at the article, we'll look at the data that they provided, and just so you know, it's not sponsored by Charles Schwab or anything like that. This is something that I just found. So I'll provide the link in the description below for you guys. Let me know what you guys obviously think of this. I thought this was kind of interesting, so let's take a look at the data here. So as always, not financial advice. This is for entertainment purposes only. Do your own research. Don't fall for scams, and spam posts get reported. Okay, so let's take a look at the article here. So here's the article by Charles Schwab. Does market timing actually work? And we'll cover the most important parts of it here, but just so some context, imagine for a moment that you've just received a year-end bonus or income tax refund. You're not sure where to invest now or wait. After all, the market recently hit an all-time high. Now imagine that you face this kind of decision every year. Sometimes it's up in the markets, other times it's in downturns. Is there a good rule of thumb to follow, right? So I think a lot of investors also have that same fear is, when do you invest? Is the market going to continue going up? Are we going to go into a downtrend? Should you invest? When should you invest? So I thought this was really good. So let's take a look at it here. Okay, so 5 investing styles. Consider our research on the performance of 5 hypothetical long-term investors following very different investment strategies. Each received $2,000 at the beginning of the year for the 20 years ending in 2020, and left the money in the stock market as represented by the S&P 500 index. Now, there is obviously a caveat to it. Not everybody's going to be able to get $2,000 at the beginning of the year to invest in, so there is some, obviously, assumptions here, right? Most of the time when we get money in, it's after we get paid, we pay our bills, we have some money left over. That's usually when we have money to invest, or obviously after we get the tax refund. If we get a tax refund, we'll get money then. But a lot of us will obviously pay off some of our bills, some of our debt when we do that. So this is kind of some assumptions obviously preset that this is what happens, but that's not the actual case or real world scenario where it would happen like that. So let's continue on here just so for clarification. So they have 5 different investors. They got Peter Perfect, Ashley Action, Matthew Monthly, and Rosie Rotten, and Larry Linger. So I thought those were kind of creative names here. So let's take a look at Peter Perfect. Peter Perfect was a perfect market timer. He had incredible skill or luck and was able to place his $2,000 into the market every year at the lowest closing point. For example, Peter had $2,000 to invest at the start of 2021 or 2001. Rather than putting it immediately into the market, he waited and invested on September 21 of 2001. That year's lowest closing level for the S&P 500. At the beginning of 2002, Peter received another $2,000. He waited and invested the money on October 9th of 2002, the lowest closing level for the market for that year. He continued to time his investments perfectly every year through 2020. So what is the likelihood of somebody being able to do that? It is very low. I don't think anybody's going to be able to time the market perfectly for the low of the year for 20 years straight. If you can do that, you're obviously an oracle or something like that. You need to find another job because you should be picking lotto tickets basically. So let's take a look at Ashley Action here. Ashley Action took a simple, consistent approach. Each year, once she received her cash, she invested her $2,000 in the market on the first trading day of the year. So there is also some thought behind this, and here's my thought. Usually we have a December sell-off a little bit because we have people are using tax loss harvesting in December. So the market usually is down for the month of December. And then it usually starts out January with another boom with people putting money back into the market. So this is obviously a good way to do it also. But it's also how many people get $2,000 at the beginning of the year to put in or whatever amount. So this is kind of hard to do as well. Let's continue on here. So Matthew Monthly divided his annual $2,000 allotment into 12 equal portions, which he invested at the beginning of each month. This strategy is known as dollar cost averaging. You may already be doing this through regular investments in your 401k plan or an automatic investment plan, AIP, which allows you to deposit money into investments like mutual funds on a set timetable. So I think most of you guys are already doing this. If you have a 401k or something like that, I do this already through my work, where I work. Every 2 weeks, they take out a portion of my paycheck. It goes into the 401k, and I don't worry about it. I set up basically which funds I wanted to go into, the portions of each fund that I wanted to go into, and we go from there. And that has done actually really, really well over the years for me. It has definitely grown, from the start 25 years ago, where I had basically nothing, to now where it's almost $300,000 in a retirement account. So it does work. You do also have to figure out which allocation you want to put into stocks, bonds, cash, things like that, whatever you want to do in that 401k. But that is one thing that a lot of people are doing. Next, let's take a look at Rosie Rotten. So she had obviously incredible poor timing, or perhaps terrible bad luck. She invested her $2,000 each year at the market's peak. For example, Rosie invested her first $2,000 on January 30th, 2001. That year's highest closing level for the S&P 500. She received her second $2,000 at the beginning of 2002 and invested it on January 4th, 2002, the peak for that year as well. So that is obviously going to be a bad one, but we'll see how this all plays out. And then finally, you have Larry Linger. Left his money in cash investments using treasury bills as a proxy every year and never got around to investing in stocks at all. He was always convinced that the lower stock price and therefore before opportunities to invest his money were just around the corner. So better opportunities were around the corner. Hopefully none of you guys fall under that category. I hope most of you guys are investing in some way, whether it's using the first month and just put everything into it, or if you're dollar cost averaging. I would hope most of you guys are dollar cost averaging. And I'm guessing nobody here has perfect timing. So here are the results. Investing immediately paid off. So surprisingly, for the winner, look at the graph, which we'll look down below, shows how much hypothetical wealth each of the 5 investors have accumulated at the end of 20 years. So from 2001 to 2020, actually, they looked at 76 separate 20-year periods in all, finding similar results across almost all time periods. Naturally, the best results belong to Peter. Peter obviously timed the market perfectly, who waited and timed his annual investments perfectly. He accumulated 151,391, but the study's most stunning findings concern Ashley, who came in second with 135,471, only 15,920 less than Peter Perfect. This relatively small difference is especially surprising considering that Ashley had simply put her money to work as soon as she received it each year without any pretense of market timing. So that's actually kind of interesting, right? That if you put the money in at the beginning of the year and just forget about it, you actually came in second place after the guy that did it perfectly, which is not hypothetically physical to do that each year for 20 years to do it perfectly. So just putting your money in January and forgetting about it, and you came in second, or basically I would think first place, because nobody's going to be able to time the market perfectly. So that's kind of interesting. Obviously, Matthew's dollar cost averaging approach performed nearly as well, earning him third place with 134,856 at the end of the 20 years. That obviously didn't surprise them. After all, in a typical 12-month period, the market has risen 75.6% of the time. So Ashley's pattern of investing first thing did over time yield lower buying prices than Matthew's monthly discipline, and thus higher ending wealth. Okay, so that obviously makes sense. As the market goes up throughout the year, she bought basically down here and basically rose the trend up. Whereas Matthew's dollar cost averaging, he bought in going up. So that obviously also makes sense. I hope that makes sense to you guys as well. But obviously there are years where market will go down a little bit, and at those points, Matthews obviously does a little bit better, I would think. But in the long run, getting in January and just riding the ride up does far better. So if you can do that, obviously not a bad strategy going forward. So here's even bad market timing trumps inertia. So perfect timing, 151,391. Investing immediately came in second at 135,471. Dollar cost averaging came in third, 134. So not that far behind it. You can see I was only off by maybe a couple $100 here. It looks like 135, 134. We're looking at $600 or so off difference. That's why I'm a huge proponent of dollar cost averaging. You might be able to buy it at a little bit higher price, a little lower price, And then obviously even bad timing came in fourth at 121,000. And then if you stay in cash, you're all the way at the bottom here, 44,438. You're basically losing money at that point where inflation is outpacing your investment income. So here's the results. So Rosie Rotten's results also proved surprisingly encouraging, while her poor timing left her with 14,300 short of Ashley, who didn't try timing the investments. Rosie still earned nearly 3 times what she would have if she hadn't invested in the market at all. So that's true. Time in the market is the best thing you can do. Do not sit on cash. Invest, obviously, what you can, and ride it out for the long term. And then what of Larry Linger, the procrastinator who kept waiting for a better opportunity to buy stocks and then didn't buy at all? He fared worst of all with only 44,438. His biggest worry had been investing at a market high. Ironically, had he done that each year, he would have earned far more over the 20-year period, right? So do not stay in cash. Interesting part here also, the rules generally don't change. So regardless of the time period considered, the rankings turned out to be remarkably similar. We analyzed all 76 rolling 20-year periods dating back to 1926. So example, 1926 to 1945, 1927 to 1946, etc. In 66 of the 76 periods, the rankings were exactly the same. That is astounding. That is true. Peter Perfect was perfect, Ashley Action second, Matthew Monthly third, Rosie Rotten fourth, and Larry Linger last. But what about the 10 periods when the results were not as expected? Even in those periods, investing immediately never came in last. It was in its normal second place 4 times, third place 5 times, and fourth place only once from 1962 to 1981. One of the few periods of persistently weak equity markets. What's more, during that period, fourth, third, and second places were virtually tied. So interesting as it can be. And then they also looked at possible 30, 40, and 50-year time periods starting in 1926. If you don't count the few instances when investing immediately swapped places with a dollar cost averaging, all of these time periods followed the same pattern. In every 30, 40, 50-year period, perfect timing was first, followed by investing immediately or dollar cost averaging, bad timing, and finally never buying stocks. So obviously we'll take a look at what this all means, but like I keep saying, time in the market is always better than trading time in the market. Peter Perfect is not going to be perfect every time. Buying, obviously, in the beginning of the first of the year, basically, putting all your money in would be second best. But how many people can actually do that? Not a lot of people get bonuses at the end of the year or something like that. And you got bills to do and everything else. So I think number 3, being only off by a couple $100 from buying in every start of the year, is the best way to go. And I keep saying dollar cost average into everything that you can. Put money in, just do it for the long run. You're going to do, like the data here shows, it's not going to be 100% of the time, right? So there's going to be some downturns in the markets and things like that. But over the historical looking at it, you're going to do a lot better. All right, so let's take a look at the results here. So what this might mean for you, if you make an annual investment such as a contribution to an IRA or a child's 529 plan, and you're not sure whether to invest in January of each year, wait for a better time or dribble your investments out evenly over the year, but be decisive. Obviously, the best course of action for most of us is to create an appropriate plan and take action on that plan as soon as possible. It's nearly impossible to accurately identify market bottoms on a regular basis. So realistically, the best action that a long-term investor can take based on their study is to determine how much exposure to stock market is appropriate for you and goals and risk tolerances, and then consider investing as soon as possible, regardless of the current level of the stock market. If you're tempted to try to wait for the best time to invest in the stock market, their studies obviously suggest that the benefits of doing this aren't all that impressive, even for perfect timers. Remember, over 20 years, Peter Perfect amassed 15,000, almost 16,000 more than the investor who just put her cash to work right away. Even badly timed stock market investments were much better than no stock market investments at all. Their studies suggest that investors who procrastinate are likely to miss out on the stock market potential growth by perpetually waiting for the right time. Larry sacrificed $76,000 compared to even the worst market timer who invested in the market at each year's high. So do not procrastinate. Invest. If you have to get another side job or something like that, the more money you can put away to build wealth, the better off you're going to be. Trying to time the market, you're not going to be able to time the market perfectly. dollar cost averaging if you can. That's kind of what I'm doing here. So they obviously are a big proponent of dollar cost averaging. So consider dollar cost averaging as a compromise. If you don't have the opportunity or stomach to invest your lump sum all at once, not a lot of people have that anyways, consider investing smaller amounts more frequently. As long as you stick with it, dollar cost averaging can offer several benefits. So here's the benefits. Prevents procrastination. So some of us just have a hard time getting started. We know we should be investing, but we never quite get around to it. Much like regular 401k payroll deductions, dollar cost averaging helps you force yourself to invest consistently. Minimizes regrets. Even the most even-tempered stock traders feel at least a tinge of regret when investment proves to be poorly timed. Worse, such a regret may cause you to disrupt your investment strategy in an attempt to make up for your setback. Dollar cost averaging can help you minimize this regret because you make multiple investments, none of them particularly large, and then avoids market timing. Dollar cost averaging ensures that you will participate in the stock market regardless of current conditions. While this will not guarantee a perfect or protect against loss in a declining market, it will eliminate the temptation to try to market time strategies that rarely succeed. Right? So they're even saying it there. Trying to time the market, you're not gonna be Peter Perfect, obviously. So I hope you guys obviously take this to heart and invest as soon as you can with what you can. As you strive to reach your financial goals, keep these research findings in mind. It may be tempting to try and wait for the best time to invest, especially in a volatile market environment. But before you do, remember the high cost of waiting. Even the worst possible market timers in our studies would have beat not investing in the stock market at all. So I thought that was just interesting. And it kind of coincides with what my thinking was on dollar cost averaging. I think it's the best way to go for most investors. We don't have $10,000, $2,000 to put in the beginning of the market of every year. If we did, that's great. If you do, that's great. That might be one way to do it. But obviously, dollar cost averaging is the way to go. Just be disciplined about it. Put in $50 a week, $100 a week, whatever you can afford. Just put it into it. Put it into the market, whether it's the S&P 500 or something else, or stocks that pay dividends. Anything that you can do to grow your wealth is the best thing you can do. Pay yourself first before you basically pay others, right? You pay, obviously, if you have high credit card debt, pay that off as fast as you can. Get rid of those high interest yield credit cards and pay yourself first. If you have to get a second job, whatever it takes, this is the land of opportunity. Whatever you want to do, you can do it. And I just said go for it, right? So I hope you guys enjoyed this. I thought this was interesting. Let me know your thoughts on this down in the comments below. Love talking to you guys down there. And we'll see you guys in the next one. Until then.